All right, everybody, welcome back to another episode of the Evernest Real Estate Investor Podcast. I am one of your hosts, Spencer Sutton, and I have my co-host with me, Gray Hall. Gray, welcome back to the show, man.
Thank you, Mr. Spencer. We need some applause music whenever you start introducing, maybe a soundtrack.
Yeah, it would be good, wouldn't it?
Some of that? Yeah, we'll get the podcast
some big cheers
on there. Yeah, something like that.
So how's your year going so far?
Excellent. Off to a good start, hitting all the goals. Yeah, I mean, you're only 3 weeks in. This is when everybody else drops off.
That's why I wanted to ask you. That's why I wanted to ask you while it's fresh.
3 weeks and a day in, so you're expecting me to be completely off track?
No, I'm expecting you to crush it, and I'm not going to ask you again until December. And I'm going to say, how are you doing with your year, man?
The year is good, and the year is better because we've got somebody new to the Evernest team, and joining us on the podcast today, Mr. Noel Christopher. Noel, welcome to the show.
Hello, gentlemen. How's it going?
Going great. No, man, you are. We won't sit here and tell the listeners where you're recording this from. Steamboat Springs, by the way, because I'm jealous, and I'm here in Birmingham, Alabama, and you're up there in ski country.
Well, it's about to snow 30 inches here. Nowhere else in Colorado is this happening. Everywhere else is getting a few inches, and then we're going to get 30 inches here. So
I was jealous of Steamboat Springs, and then every day we hop on calls and just catching up. And he's like, "Yeah, I just got done shoveling the entire driveway every single day," and I'm appreciating the 1 inch of snow that we got over here.
Gray has heated driveway, so don't worry about that.
Yeah, I'm a professional berm buster from the snowplows making these gigantic berms. You walk out to go somewhere, and you're like, "Oh, great! Let me go put down all my snow gear and wrestle the snowblower."
Well, listen, we're glad you're here. We're excited to talk to you because now Noel is new to the Evernest team, but he's not new to this industry. As a matter of fact, he's an expert. He is our chief real estate officer. And first, I want to say we're very excited to have you on the team. Obviously, you've been with us for a couple of months now, but great to have you here. And I'd just like to maybe kick it off with telling a little bit of background, your background and how you got into the industry and what you've been doing.
Sure. Yeah, absolutely. So I started out if you really want to go deep, and some people may know this name, but I used to be a sales trainer for Tom Hopkins. And Tom Hopkins is the guy who wrote How to Master the Art of Selling and How to Master the Art of Selling Anything. And I was doing car dealerships and mortgage offices and real estate offices and giving sales training seminars and selling a book. And I would do this 45-minute presentation. My goal was to sell tickets to a seminar. And so I'd hold up a book and said, Tom says the whole time, and then sell books at the end. And I would get paid to sell these tickets. And I went around for 2.5 years, lived in a market for 3 months, and would go around and do that. And so that's how I got into real estate, actually. And commercial real estate in Chicago was one of my markets. I never left and got into commercial real estate. 10 years after that, I got into single family rental just after the great financial crisis. It's a really long story or short story. One of my good friends who's now deceased from college happened to be best friends with Dallas Tanner, from the CEO, now current CEO of Invitation Homes and the founder of Invitation Homes. And he introduced me to Dallas back in 2012, and we started buying our team in Chicago. I was working for a commercial real estate brokerage. We started buying houses and bought 1,000 houses for Invitation Homes and another couple of thousand for other funds in Chicago, and then another several thousand around the country. And we had a centralized underwriting team that were underwriting homes all around the country. And that's how I got into the SFR space. And I've never left since then. So since then, I've worked for a couple different companies on the data side. And then more previously, I worked for a Renters Warehouse, and now here at Evernest. So exciting stuff there.
Yeah, well, we're great. I mean, we're excited to have you. And I've been enjoying your market updates that you've been doing. Now, if you don't follow Noel on LinkedIn, you can go and follow him on LinkedIn. Just look for Noel Christopher. He does market updates probably, I don't know, twice a week or so, Noel. And they're great. They're fantastic.
Yeah, I started, I don't know if anybody follows Gary Vaynerchuk. I was watching one of his videos one time and he said, turn on the camera and just talk. So I started doing that a couple of years ago after I would drop my kids off at school in the morning and would just train of thought, whatever is on my mind about the real estate industry, what I've been reading, a lot of data, but without notes, just as I'm driving the car. And you can have some pretty higher level creative thinking going on when you're driving because of all the different functions that you're using. And I've been doing it for about 3 years, and it's more layman's term, breaking down the market, the data, debunking a lot of the YouTube influencers who are peddling financial narratives and or economic narratives to get clicks. And so, yeah, I've been doing it for a while, and it's hard work to come up with things to say, but it's the best is when I just turn on the camera and just a diarrhea of information comes out, and sometimes it's good, sometimes it's not.
Well, that's why we just turned on the microphone here and said, hey, let's just talk. And we're going to talk about, is now a good time to invest in the real estate market, specifically single family residential. So we do want to get your take on that. And, again, layman's terms are perfect for us because that's on my level where I can understand it. You can talk to Gray on a higher level, but make it to where I can understand what you're saying.
So, and I would love to get Gray's in your opinion on this, because you're both very experienced in this space. I really look at it in a couple different ways. Is just on a really basic level, when you're investing in the single family rental, you're really looking at the long term, and you can ride the up and downs of the market. I think that, with the recent rate changes, that's gotten a few investors in trouble with the kind of debt that they have. But really, basically, if a deal cash flows today and it's going to work today, and you're understanding where the short-term market's going to be on rents and is this a good neighborhood to invest into, long-term, it's going to be a good investment. I mean, think about everybody who had wished they had held their house after the great financial crisis, and think about the people who did hold on to their house during that time and where they're at with rents, where they're at with values and wealth creation. It's sometimes a misnomer to say real estate always goes up, but residential real estate over the long term always goes up with its ups and downs. I think the more the people that get in trouble right now are the home buyers who bought with the anticipation that they were going to sell their house in a year or two. And it's really easy for people to get caught up in that quick, appreciation mode when it's just, you want to look at the long term. So that's, we can go deeper into some things, but in a nutshell, if it works today, it's usually going to work tomorrow. And
long term is like super important. I saw this guy on Twitter the other day and talked about, hey, I got into real estate, and he'd only bought real estate for 1 year, but he talked about this major cash out refi he did. And he's like, that shows the power of holding real estate long term. And I was like, that's a bull market right there. And so there has been this, like, even the past 3 years, really 2019 to 2020 to end of 2022, where it's like, hey, it just went up, but I think the fundamentals have changed, is kind of the point that you're making. And you can't bet on that and making these short-term 1 to 2 year bets. Like, that's how you can lose right now. You also said something, I think this is kind of a narrative going around, is you mentioned the people who are in trouble, like, comes down to the financing of the property or the debt. Like, talk a little bit about that. Like, 2008 was, a lot of it was around adjustable mortgages and really lax lending, and like the ninja loans, like no income, no job loans, plus adjustable rate mortgages that might have been interest only for a period, and it all started to kick in 07, 08, 09. That's been cleaned up a lot right now, right? I mean, like, who would be in trouble from financing standpoint?
So two comments on that. Well, the first thing, who would be in trouble are more of those that actually took that route, but on the commercial loan side, where lenders were lending based off of the non-recourse loans, based off the fundamentals of these houses that were pretty lax. There's a lot of money that needed to be put out on the commercial markets. But what's really interesting in single family rentals is it's really anchored by the overall home market. So it's something different than in multifamily, than in industrial or anything else. You can look at the income of the property is one ceiling, and then the value of that home is another ceiling. So if home values go down, just because your income supports a higher value, that home value is going to set the ceiling for that house. And so that's a good and a bad thing. Most of the time, long term, it's a good thing. But as far as and there's a Logan, and I don't want to butcher his last name, but from Housing Wire, does a great 20 to 30 minute podcast every morning. It's on Spotify. And he talks about this quite a bit, about the differences in credit makeup. And so the lending standards since the great financial crisis have been very, very, very strong. Meaning that they weren't banks were not loaning money. I mean, I think the average credit was 720, and it's even gone up recently. So the quality of the borrowers, the due diligence that the banks have done, the experience they have with REOs and not putting homes into REO as quickly and working those loans out because they realize that they save way more money by not foreclosing on the home. You're not going to see this tsunami of foreclosures happening. And what happened with this most recent reset is that it was very front loaded. So extreme rate increase, we saw immediately some adjustments in pricing, adjustments in rents. And then what's being predicted that's going to happen in the next year is a slow burn. If there is a decline or staying pretty flat, moderate appreciation in some markets, except for some West Coast, Vegas, Phoenix, Boise, California, that went way, way up. So it's kind of funny because you talk about a market like Phoenix that went up, let's say it went up 60%, I think, or 50%. Well, it's adjusting down 25%. That would be in crash territory, but people who bought homes, most of the people who bought homes are still in a good financial position. Right. So it's going to help affordability. And Phoenix is considered, and Vegas and Boise actually are still considered very affordable markets right now. So even going down, it's going to make them a little bit more affordable. California is kind of a whole different thing. And I don't even like to talk about California because it's impossible to do business there, and it's hard to do business there. It's hard to invest there and everything. But the fundamentals are much stronger. And so you're not going to see this. That's the big question everybody wants to know. Are we going to see values just dump across the country? And you have a lot of people talking about, is it a good time? Are we going to wait till we hit the bottom to invest and we're going to get these great deals? I don't think that's going to happen too much. You're seeing some adjustments. You still see wages still going up, values adjusting down a little bit, rent adjusting down a little bit, helping affordability, but affordability is not going to get much better for a while. And that's why investing in rentals is a strong thing to do.
And I think another component of this too, so you were talking about a lot of people are saying, hey, I've got cash on the sidelines and waiting for this crash. Like, I think some of those fundamentals you just pointed out aren't going to lead to that. I think another interesting stat is like 85+% of single family mortgages are locked in around that 3% number or sub 3%. So what you're starting to see, so my question around like inventory is, and like sitting in this right now, like my house sub 3%, don't want to sell it. Anything that's an upgrade, or if you even same price level, your debt costs are going to double. And so I think that's going to force a lot of people to stay in their homes, causing a further kind of inventory contraction. And that's just kind of supply and demand. And so I think what we might see is really kind of things remaining flat until debt like levels off. But we've started to see like demand pick up. I think mortgage applications are up like 32% week over week. And so we're starting to come into the year, don't fully know what that is. I don't think anybody really does, but I think like, hey, I don't see any of this big crash. I think people say they're waiting for that, but I don't think it's going to happen. I think inventory is still going to be constrained because of that, sub 3%. And like people do not want to give that up.
Well, and if you really think about this, the inventory is driven more from sellers so the demand is driven more from sellers than buyers necessarily. And it's a little misnomer, right? So new home buyers are what? 30 to 40% of the market typically. So the rest of that are people who sell their home who then become a buyer. So if they don't sell their home, they're not going to become a buyer, period. So you still have some demand. You have demand on new home first time buyers. You still have a lot of demand there. And that demand, that's what's really pushing mortgage applications. It's less the people who are going, oh, well, I have a 3% mortgage and rates are at 6%. I'm going to sell now. These are people who are forming households, who need a house to live in. And they're applying for mortgages, and what they're finding is they can go look at a build for rent development down the street and buy a really nice brand new 2,300 square foot home and rent it for $2,500 a month, or get a mortgage for $3,500 a month. And it's pretty simple math, because the experience that you get as far as the living experience and the expense experience is, I mean, you're saving a lot of money, and you don't have to deal with upkeep. You can decide to move if you want. You can be transient, all these different things. So a lot of people by choice are deciding to rent, and the competition is no longer a small investor who bought a house, put the minimum, not that all small investors do this, but put the minimum amount of work into the house, self-manage it. They don't have a great tenant experience, and they're walking into a more of a homeowner-like experience. And so that drives to the rentals as well. But there is not, I mean, people aren't selling their houses. So that is a huge part of the supply. And this is also why I believe, and we can talk about this more in a minute, but why the new home market will rebound much faster than the resale market, because people still aren't selling their houses, but the home builders need to sell their houses. And remind me in a minute, we'll talk about this. The home builder supply is a much of a misquoted number of that 9 months of homes. So what do you see? What do you see happening with rents? Because you mentioned that they're leveling off, right? So we saw historic rise in rents, and but you're talking about the supply continuing to dwindle. Like, what do you think the future is going to hold for rents? So unlike home supply, the rental supply has increased, so that's affected the rents. The demand to move from the city to the suburbs, because it was free money, that's slowed down a little bit. So the demand has gone down a little bit, but really what's happening is there's more rentals coming out of the market. I mean, somewhere between 10 and 15% of home sellers who decide that they want to sell are now deciding to rent. And that's something that we're targeting, obviously, at Evernest. Is, these people are saying, well, it's different than it was back in 2008. Just the data and information that's available. You can go find a podcast, you can go find somebody and go, well, and you can look at home values of where they were in 2008 and where they are now. And people are deciding, maybe I should hold on to this 3% mortgage. I don't have to pay, the taxes, and maybe you don't on the first sell, but you're going to have to pay it at some point. So you hold on to this, you get a lot of write-offs. There's a lot of reasons to hold on to it, and mostly because of the cheap debt. And so you might as well just rent that home out. So that's causing rents to slow down. Now, I think rents, I was looking at some from CoreLogic. I mean, the rents are still, 8% across the country. I mean, look, 4 years ago, if we said values go up 3%, rents go up 3% a year, every year, people are high-fiving and thinking it's great. All of a sudden they go up 10, 20, 30%, and then they slow back down to those lower numbers, and people are freaking out because they think, it's a big crash. The appreciation has slowed, the rent appreciation has slowed, but it's still going to stay strong, minus certain markets that might be hit harder financially. I think around car industry, I'd be a little bit concerned. Unlike, anything that's anchored by any kind of government jobs, things like that, or medical as well.
So how should investors be thinking about that? Because where is, so to speak, the bottom of rents? What are the factors that would keep driving them up over the long term? Because you're sitting, hey, home values are slowly correcting. I'm starting to see more price drops. Now, not a crash, but hey, probably correction. And it's hard to know, did they list that home at $400K and it's really a $300 home K, and they were hoping to get 2021 prices, and so they've cut it down to a reasonable number, or are values dropping? I think that's part of the headline can be driven by that, but same thing on the rent numbers. And so we've got more people are probably going to look at becoming first-time landlords with their homes. We've got also just kind of newer supplies and build for rent kind of adding to the market. What do you see that rents will stay flat, and how should an investor think about that if they're thinking about investing in Q1 of this year?
So for one thing, on the list prices, it's interesting metric to track purchase to list, but it is a useless number because we don't know, that list price is not a universally consistent number. One person or one data point is not used for all the list prices. So people could be being aggressive in one market, not aggressive in another. So the discount to list is a is kind of a useless number. Discount to value is something where we're seeing, maybe with home builders, you can buy them at 93% of value. And Gray, I think we were on an email earlier today when someone's like, "Oh, can I get a 15% discount?" It's like, I don't think so. Right. But with the rents, it's really looking at the inventory in the market, the scarcity of housing or lack thereof. And you want to be, if you want something that has higher rent growth, you want to be in a market that has a scarcity of housing. What we don't know is that what is the tipping point that's going to cause more people to put their home on the market to create more inventory. And so that's a tricky number. So I would say in Phoenix, you want to be more careful because you've got iBuyers they own thousands of homes. You have a lot of homes on the market that institutional investors bought. So Phoenix, Atlanta, even Boise, even Vegas, there's an inventory thing. You have to be careful because turning of the dial to get homes rented out could affect your NOI on that rent growth. But very rarely do rents in single family rentals go negative. Even during the great financial crisis, multifamily rents went negative because you have more people in the lower income tiers who are not able to afford an apartment, and they're more affected by job losses, car delinquencies, all of these credit card debt. So the rents adjust downward more. You have higher delinquencies in single family rental. We're typically single family rental. If you want to look at what we would recommend somebody to invest into, focusing on a little bit better tenant with better fundamentals, because there's a demand there, and they're keeping their jobs longer, and they're going to have more rent growth. And you look at the rent to income is still nationally, I think it's below 30%. So it is still more affordable to rent, and there's room for rent growth generally across the country in most markets, even when you have this misconception that rents have just gone crazy. Well, but wages have gone up. And so what inflation has done to that, we'll see. But still, even then, rent to income is still, at an affordable number.
I'm sitting here laughing to myself because when you start to visually think about this, you're like, well, if this moves here and this moves here, well, this might move here and this might move here. And it's like, this is all, it's like, I think that's why investing can seem pretty overwhelming because there's so many different data points. And I think if you kind of zoom it back, you're just like, hey, invest for the long term. And the message is still the same, whether it was this year, the previous year, or in 2011. It's like, do you have cash reserves? Okay, check. Hey, start looking at a market. Does it have good fundamentals? Is it a growing market? Is there good, steady jobs? Check. Okay, am I running my numbers conservatively? So on that point, when you're looking at, hey, rents are decreasing, hey, run your numbers. And if it cash flows at 10% below market and homes are going off the market in 30 or 45 days, then, hey, you're probably in a good spot. So don't be overwhelmed by all this information. I think it's just interesting to have all these different data points. And a response, on, I think another factor that drives rents up is right now it is cheaper to rent than to buy in most markets. And so as long as that continues to be there, yes, we might have more people putting homes on the market because they're not selling. That person might go to rent. If they had, one or two kids, they've got to move up. It's cheaper to rent for the short term. They might be doing that. New household formations, they also might be renting. And so you've got these kind of two different pressures. Yes, there's more housing coming on. However, there's continually, there's still demand, at least from that side. So it's hard to put a specific number on it, but I do think it's not all negative on the rent front. Rents haven't gone negative year over year is what you meant, even in 2006 to 2012.
So I guess this would be the one thing that would be a really good thing to look at is average mortgage payment, average rent, right? In a market for a 3-bedroom, 2-bath, 4-bedroom, 2-bath, whatever it might be. It's a really easy number to look. And if the rent is less than the mortgage, it's not that is a green flag in that market to start looking at other things, employment. You can go down a rabbit hole, right? The other thing, just on the housing market in general, there are not many forward indicators except for one, and that is mortgage applications. So the more people are applying for mortgages, that is one of the most accurate forward indicator in the housing market. Everything else is looking back. Pending home sales is a little bit of a forward indicator, but mortgage applications is one of the biggest ones. So as those go up, the demand goes up. That's going to keep pushing prices where they're at.
And you just mentioned something though. If the price to buy the house, the mortgage is higher than the rent, it's a good place to look into. That makes it a challenge though if you're trying to buy that home, because if rent is less than the mortgage, that obviously goes against kind of the advice there. So how should people be thinking about that? Is that where you have to look harder for a good deal? You have to figure your way out some value, or you might just have to put more cash down?
Yes, all of those things. And so if you're competing against a home buyer, you're trying to buy a house that needs less than $15,000 of rehab. Mm-hmm. You're buying a house that's usually newer. So if you look at that, that's why there was something that came out just recently. Institutional investors buy on average 25% below median house price. That is because they're buying homes that need more work, where they're not competing with a home buyer. Now, one of the big issues with financing in this country is that if you're a home buyer and you want to buy a house that needs a lot of work, it's very, very hard to get the 201k, I think is it, whatever it's called, loan, or 203k loan to rehab that house. So that's a target of investors who are buying a little bit older inventory that needs to be fixed up. So that value add, that you're not competing with a home buyer all the time. You want to be competing maybe with other investors, flippers, which the flipping market is kind of non-existent right now. So there's some opportunities to buy those older inventory homes that need more work, that you can create some value, that are in up and coming areas on the edge of an area that's gentrifying or changing or growing. And there's some opportunities there. So not competing with home buyers every time.
Yeah. And I feel like there's this window. Obviously, we don't have a crystal ball. I feel like the last 6 months of the year, like prices haven't adjusted yet, but sellers were starting to get desperate towards the end of the year. If mortgage applications are picking up, the question will be, hey, is the spring kind of typical listing season when a lot of single family homes go on the market? Like that will probably be a big indicator. We might be closing out, like if debt has just become 6%, 6.25%, and that's what everybody's used to, they might just have reset expectations in terms of pricing. So buyers are kind of more willing to buy. I think that plays into the home values will likely kind of remain flat. I think you're gonna have just less supply, and less historical kind of buyer demand, but interesting to kind of like look at that. Is now still a good time? I think it probably is, where you can see a house sitting on the market for 90 days. And if they need to sell that house, you can start making some offers below list and start to get a good deal. And yes, debt may be 6%. Maybe you need to put down 30 or 40% on the home, but give it, 2, 3, 5 years when, rates come down, and you got the opportunity to refi if you've got the capital reserves to do it. I mean, that could be a strategy right now to execute on.
Yeah. Well, and I think the going thought right now is that if rates get to about 5.75 or below, it's going to push a lot of buyers back into the market. Maybe not as many sellers, but buyers. So there's still that inventory issue with the sellers. One thing I know in a lot of markets, and if you're working with a realtor or working with one of our people, you can, on the MLS, the agent can go and pull the tax records, and you can see what kind of mortgage is on the house. So you can look at this house and go, wow, this has been on the market for 90 days. The house is worth, it's listed for 400,000. They've got a mortgage for 300,000. You have some room to negotiate there. And that's a really good tactic to kind of see, to start negotiating with that seller, is understanding where their mortgage is and how much, basically how much equity they have in the home. That's
why you get wholesalers and flippers calling you if you've owned your home for 10 years or longer, because they're pulling the list. Like, I want to contact everybody that's owned a home for 10 years or longer, because they know the mortgage has gone down for the most part, even though there's been plenty of refis out there. Yeah. Well, I think the equity is still, it's pretty, there's still a lot of equity. Even the people who bought during COVID, house prices from today, I think would have to go down more than 15% for those people to be underwater. And this is a very broad statement, but to be underwater on their mortgage. So we saw such an increase. I used to have this idea of that if house prices go down 5%, it's not a crash. 10%, we're kind of getting into a crash. 15%, it's a crash. That's changed because of the amount of appreciation that we had. So in some markets, 25% would be, still an adjustment. It's kind of crazy.
Yeah, just because things have run up so much. When you have 10 years of 3% opposed to, a couple years of 10, 20, 30%, like net, you're still in a good spot if you bought in like 2019. The only way you might be in a bad spot is if you bought in, end of 2021 or, beginning of 2022 when home prices were kind of still elevated. But that speaks more to the home buyers. And, those are tough to kind of make deals work on. Hopefully, if investors bought those, they've got a tenant in there and it's rented out and they've got they're wanting to hold that for 5 or 10 years. But I think the days of the short-term speculation, you buy a house and a year later it's worth $100,000 more are over. That's fueled by sub 3% debt. I don't think we'll get back down there. And so it's just a change in strategy. And hey, kudos to people that took advantage of it. You're taking on more risk. And but you also need to realize, hey, that was a bull market created by a bunch of different factors that probably are not going to come together again. Now, in 10 years, we'll probably be sitting here and we'll be talking about this other bull market that was created by this new set of factors. So it always kind of shifts, and what causes the run up wasn't the same as before. But I think the strategy has shifted back probably more towards, hey, this kind of feels more normal, maybe 2 to 3% home price appreciation. And so you're getting into this hopefully for cash flow and long-term equity compounding by having a tenant pay off the debt. So the fundamentals are probably still the same. The strategy just has to shift back to long-term horizon opposed to short-term.
Yeah, there's a lot of people who took advantage of the appreciation play, and there's a lot of people who got burned by it. Yeah. I mean, there's some pretty decent sized funds. I think I'll get burned by it. I think there's some larger, when they talk about the institutional investors, there's a lot of talk about the demise and they're going to sell all their assets. That's not going to happen. But there are some, it was pretty easy the last few years. And so a lot of people got into this that maybe shouldn't have. And this is kind of cleaning out some of those non-fundamentally bound investors. But I think it's really funny how people can't forget 2008. And they assume that we're in that type of a situation and everything's going to crash, but then they forgot it. There's a whole nother subset of people who forgot it and were playing the appreciation play and are like, oh my God, what happened? And so it's this funny thing how people forget and don't forget. They forget what they shouldn't have and don't forget what they should. So. Mm-hmm.
Yeah, I think one last thing we can talk about is if you've got a home on the market, if you're buying a home, past couple of years, like what have you run vacancy at? I mean, I've seen a lot of that, like 5%, even sub 5% in some of these markets because homes were flying off the market for rent. Is that what you've been seeing?
So I really saw this happen 2021 and on. A lot of people started playing with those numbers and even lenders to make the deals work. So they said, well, bad debt, we don't need that. Let's just take that off. Vacancy, 6%, underwriting. Now let's push that down to 4 or 5. Mm-hmm. And so now I think you're going to see back into those fundamental assumptions. Even though single family rental vacancies, are still low. I mean, if you're in the, well, here's an interesting part. Mom and pop investors, I think vacancies are somewhere around 10%, whereas a professionally managed home is more like 6%. Lower income housing, Class C below, is a much even, is like what is it, 16% vacancy in some instances. So depending on how you have these homes managed, that's one thing that we're on our leadership channel. We're talking about more of the regulations coming in about renters. They talk about how they want to keep the larger institutional investors out of the market, but then they put in all these regulations that requires only the really smartest and the most with scale to be able to do that. The difference is with property management, and this is a small bit of shameless plug for Evernest. Now you can hire a professional property manager to handle all that for you because it's getting harder for a small investor to self-manage a home, especially if you're in any kind of a million plus municipality or city. They are starting to put all these rental regulations, and that's going to lead to the smaller communities. They're making it very hard to own a house, very, very hard. So it's pushing out those who self-manage, and it helps what we're doing, but you can benefit from the scale of what the institutional investors have. So
yeah, regulation is definitely something to look for. I think you've seen investors look at states that are more business friendly, landlord friendly. And look, so I think that's a factor to kind of like look at. And I think right now on the vacancy subject, like vacancy was, if you put up a home for lease, like it was getting leased and it was getting leased quick. We had no seasonality for 2 or 3 years was part of the reality, both on the for sale market and on the for rent market. we're starting to see seasonality come back in. It is slower now than it was in the summer. That's normal, but also don't build in 4% vacancy unless you're, pretty fine tuned on that, because it's tough when you go in underwriting. Hey, I want to get slightly above market rents and I'm going to push vacancy to 3%. You're going to be sorely disappointed. Would be just kind of a broad statement. Now, maybe you're smarter than me, and that probably is not a very hard thing to do. But I think making sure you've got conservative numbers, because we're starting to see that seasonality come back in.
Well, I was telling everybody that it was the marketing. The marketing department was doing such a good job getting these houses out there.
That's what we let you think for the past couple of years, Spence.
What do you, Noel, why do you think it is that low to moderate income housing has more vacancy? Is it just because what you had mentioned earlier, that they're more affected by, job loss or, crisis? They have less money in reserves, or why do you think that is? I've had experience with low to moderate income houses and had people in there for 10 years in some of these properties, but would like to hear your thoughts on that.
So I think it depends, right? So are you talking about a 2-flat in Chicago? Are you talking about a housing choice voucher in the suburbs of Chicago, working family?
We're probably not talking about Chicago.
Right. Yeah, let's not talk about Chicago. But so
housing voucher, tertiary market, Birmingham, Little Rock, Chattanooga, some of these low to moderate income places.
Less wage growth, less money to put into fixing up the house because of a lower rent, right, on the turns. So you're going to have a lower quality product typically. It just, you don't have, when there's a lot of layoffs, I mean, forget about Google and Amazon saying they lay off 10,000 people out of 155 million people employed. It's a drop in the barrel. The unemployment rate of of tech workers that get laid off is like 1%, right? Because we'd love to hire some of those people here. I mean, it's just, there's a need for them. But when you start seeing service sector and you start seeing the lower income unemployment, there is not a place for them to go. So if you have somebody that's living in a $1,200 a month house and they lose their job, where do they go? Where do they move to? There is, in my opinion, an affordable housing issue crisis all across the country, whether you're living in a place like where I'm living, if you're living anywhere else, like that is a bigger issue. They've decided not to increase the funding for low income tax credits. They decided not to increase the funding for housing choice voucher program. Those were all just stripped out of the budget, where a bunch of other, that's a whole different conversation, was put in that probably shouldn't have been. So that is the huge issue. There's not a step down. If you're making $100,000 a year and you lose your house, you have a lot of options of renting different levels to move to. But when you're in that bottom tier and you lose your job and you're living in an apartment, there isn't the next level to go to. Not everybody has their parents' house to move into. No. So that's why there's it's a little bit some more risk, but also a huge amount of opportunity if you can solve that housing problem as an investor.
Sure. All right, Noel, man, this has been great. Been fantastic having you on here. I'm looking forward to you being on more. Now that you're here with us, we've kind of got you captive in the Evernest incubator and can call on you as many times as we want to. So we really would like you to come back. All right, everybody. That's it for this episode of the Evernest Real Estate Investor Podcast. We'll be back next week with a new episode.